I'm really playing it up like this is a contrarian view. It seems natural that it's going to evolve this way, or maybe there have been other times when we've paused and then started hiking again, but that would just seem so odd, even though that's what the market's betting on.
No, listen, I think probably the best analog for this is the very aggressive 94, 95 rate hike cycle. And in that case, the Fed tightened 300 basis points in a year. The stock market rallied from that maximum point of hawkishness, the 75 basis point hike in November, through when they confirmed the pause in June, 22%. We've rallied something like 20. So there's lots of similarities. But the big difference, though, is we had a similar magnitude of yield curve flattening. 2s, 10s came down 180 basis points or so, but only to zero.
Oh, so
now we're stuck 100 basis points negative. And the banking system has an ongoing problem. And I think what we're going to find over the next 3 to 4 weeks as Treasury ramps up issuance is that the money is not all coming out of the RRP program. It's not going to be government money funds that buy every dime of that Treasury bill issuance. It's going to put more pressure on bank reserves so that we have another leg lower in that deposit growth. Credit growth is decelerating rapidly.
Just to mention, we're literally about to talk with my next guest, Brian Reynolds, about that exact issue of deposit flight going into money funds. So your point about that is simply that we're going to see renewed stress on the banks and maybe on broader kind of economic growth.
Correct. So I've described it as the Fed's trilemma. We are going through disinflation. That was my main thesis for the first half of the year. We're going to lap 2 very hot comps for CPI. We're bottoming right about now, but we won't, of course, know that until July. At that point, CPI is probably going to be 3.4%, meaning by the time we see the June number. That takes some pressure off the Fed. It doesn't get them back to target, but they should be patient with respect to that. Though at the same time, the pressure on the banking system is going to build. I suspect by the fall, bank reserves will fall from their current level of 3.2 trillion down to about 2.7. That will force the Fed potentially to stop quantitative tightening.
Yes, and Jamie Dimon has alluded to this already.
Correct.
That, and we saw they tried to start it in 2019 and they very quickly had to back off. Let me ask you, so 1994 was a soft landing, and it seems like because of certain things like the tightness in the senior loan officer survey that we don't have the same setup now that we did then, unfortunately. I mean, do you think that we're heading into recession here ultimately?
Well, this is the point that we're at, right? Where the probability of recession is much higher in mid-2023 than it was in 1994 because of the fact that yield curve is 100 basis points inverted. The banking system is in a much more tenuous situation. No term facility is going to work when you own assets that yield 3% and you finance them at 5%, right? So the only way out of this really is for the Fed probably to reverse some of the rate hikes, and I think they should do a reverse duration twist, sell some of their longer duration treasuries, buy short duration treasuries,
and
increase the reserves,
curve,
disinvert the yield curve, right? Steepen it, of course. And then the banking system can earn their way out of it, particularly when you talk about adding more capital, which isn't going to happen right away, but still.
If someone was listening to this, they say, wow, this sounds pretty bearish, but you've been overweight equities. And why? So, and a lot of people have said, Spallanzani and others have said, the market's rallying because it's rallying on the pause. This is all about the Fed pause or pivot, whatever you want to call it. But if that's true, why do they still 80% chance of a hike in July, right? Like, I could understand if the market was rallying and thought, like you think, that the Fed was going to be done here, but I don't understand why they would rally if they think they're going to keep going.
Yeah, one of my core themes for the first half of the year was until we got a debt ceiling deal, we were going to have plenty of liquidity in the system. But once that debt deal got done, then we were going to have what I'm calling liquidity, another extreme liquidity climate change storm, right? So when the Fed started with QE, created all this abundant reserves, it's called an abundant reserve system, they created a situation where we were going to have these violent storms. Now, I think we're due for one of those storms. Because of all this issuance that we get, we will probably have a risk-off episode. I don't think the equal-weighted S&P will go down very much at all. The cap-weighted one could go down. We could take a lot of the froth out of AI stocks and banks.
Exactly. Just to put a point on it, then, you're not going to be one of these people saying, "I'm getting in on the Nvidia trade. I'm piling in on the Nasdaq."
Not now. I mean, I love the idea that we're going to have a very strong productivity cycle throughout the whole of the 2020s because of deeper capital expenditures, because of higher labor dynamism, and because of technology investment diffusing to different industries, not just the producers of that technology, but the consumers. But right now, we're about to have a bit of a liquidity shock. And so things like buying the equal weight and selling the cap weight S&P, lightening up your tech exposure, I think you want to be doing those things because we have a storm coming.